imagine it this way. Before the 1980s, what big banks did was they lent money to businesses that actually produced things. So you would find that in those days, Citibank would be lending money to, let's say, General Motors, be lending money to, other large corporations. The development of IBM, would all be financed by banks saying, yes, we're very happy to lend you money because we like your business plan. And they can see that there's a string, if you like, of earnings on the back of that bank lending. And it was secured on real assets like factories and, where shares were taken in, you had a dividend stream as well. So you could see that the collateral that a bank took in actually properly backed the loans. Now, that's a very important point. Then in 1980, we had the Big Bang. And what that meant was that banking became reformed. The Glass-Steagall Act, which separated out commercial banking from investment banking, following the Wall Street collapse and all the banks that went out of business then, suddenly we forgot about that, so we'll rescind it. And it's inconvenient for the future. So they rescinded that, which basically meant that the big commercial banks like Citibank and JP Morgan and Morgan Stanley and White World and all these sort of big banking operations just went purely into financial activities. And it was the start of, first of all, regulated derivatives, and then you had over-the-counter derivatives, and then you had hedge funds. Purely, this is just playing around with bits of paper. And it's got so much that, of course, and the other thing, as far as these big banks are concerned, they can see the collateral value of this paper rise and rise and rise. Why? Because interest rates are falling and falling and falling. So it's been this is really sort of fueled a financial bubble, which the banks have been very much part of fueling. They've expanded bank credit very much into financial services rather than lending to real businesses, which actually produce things, which produce an income, which justifies the loan in the first place. So you can see that it's all changed. It's completely changed now. And we have got to the point where we're really at the top of a bubble. I mean, when you see interest rates go to zero, I mean, that is the end of the trend. And of course, in Japan and in the Eurozone, I mean, they not only went to zero, but they went into negative territory, along with a few others. That was if you want a definition of a bubble, just look and see what has been happening in recent years. And that is the top of the bubble. So financial bubble, what happens when interest rates start rising? Well, here we've got actually rather a worrying story, because the reason interest rates are rising isn't because of nasty Russians withholding gas and whatever, whatever the story the politicians tell us. They always tell us this. But it's actually because the central banks have been printing money like billio, and the banks have been expanding credit like billio on the back of that as well. But this time it's actually mainly central banks that have been doing it. The result is that the purchasing power of their currencies has declined. They've been debauching their currencies, and that is why prices are rising. So we've come to the end of this trend where interest rates went to zero or even negative in some jurisdictions. They're now going to rise because when you see, look at Germany. Germany's just announced, I think it was earlier this week or last week, that the producer price index has risen 30% in the year to end March. There's going to be more to come, because that was really before the Russians, did the nasty thing, if you like, and said, well, we'll sell you oil at a reasonable price, but you got to pay in rubles. So that was all before that happened. 30%. And what's the ECB doing to interest rates? Since then, they have reaffirmed a deposit rate of -0.5%. I mean, this is crazy. These are markets that are about to break. It's as simple as that. And in Japan, if you go back into March, you found that the Bank of Japan, which has really, become an enormous portfolio of mainly bonds, but they've also been buying equities in ETF form. They said we will keep interest rates where they are, which basically is sort of a little bit negative. And the 10-year bond, we are going to pin. This is yield control or yield curve control or whatever you like to call it. We're going to pin this at 0%. And then sort of 3 weeks later, they had to change that and said, we're now going to pin it at 0.25%. Now, you can't believe any numbers coming out of Japan. On the one hand, it is a savings-driven economy, so the tendency towards consumer inflation is lessened. But on the other hand, the government takes money which is printed by the Bank of Japan and uses it to subsidize transport and food and various other prices. So, do you believe the CPI there? No. I mean, what they're doing is they're printing money to suppress effectively to suppress evidence of inflation. I mean, this is just crazy. This is crazy. And it had to end. And the thing that will end it is rapidly rising interest rates. And markets haven't even begun to understand the ferocity of the situation that is now unfolding. So that basically is why I think to look at it in terms of the